And we should be live. Alrighty, welcome everyone back to another episode of Negative Two Accountants One Gap. It's just me. Uh, Sorry I've been late as far as getting content out. Still working on the template for interviewing people. Um, Finishing touches should be just about wrapped up, but I figured, might as well give some value here. And one of the topics is I know that not everybody has had managerial accounting, uh, and if you've taken a look at the description, you'd see that hey, this is not exactly gap, and it's not because contribution margin and unit economics aren't really true gap details, but if you're finance inclined or you're even again, like I said, in my case, I came across this with managerial accounting, contribution margin, break even analysis, so on and so forth. Was in that class. So uh, here we go. So some definitions. Contribution margin does not equal gross profit. Oh, hello, Lincoln. I hope you are doing well on this Saturday. But yeah, contribution margin does not equal gross profit. Contribution margin ratio does not equal gross profit ratio or gross ratio. What the heck is contribution margin? So that would be your total sales less variable costs. And if you wanted to make it into a contribution margin ratio, total sales minus variable costs is your numerator, and then as your denominator, you would divide all this by total sales. What the heck? What the heck is this all for? Why the heck do we care? Uh, if you care as a investor, as an operator, as a possible entrepreneur, this is one way to try and get into the nitty gritty if you choose to operate in a business that this is warranted. Um, because some things require input costs. Could be electricity costs. Could be physical goods, raw materials like I don't know, some sort of plastic, some sort of some metals, whatever. Could be also that you have labor input costs to make a product happen. Um, could be making shoes, donuts, whatever the heck it would be. This is how it would break out. And how would you use this for break even? So from a break even perspective, you would take your fixed costs as your denominator, and underneath it, I mean your numerator. Sorry, fixed cost is your numerator. There's the first mess up right there. And as your denominator, you'd have sales price per unit subtracted by variable cost per unit, and that uh, whatever that equals out to, that would be your denominator, and you divide your fixed cost divided by that. You could also figure out how many units you need, assuming you know your total fixed costs and your contribution margin. You might also want to know your break-even sales price, which case it would be your total fixed cost divided by your contribution margin ratio. Uh, what the heck does this mean? Well, in the case of this topic, because we're not talking about gap, accounting profits, we're using the most simple, possibly like more of an economics type of a definition of profit, where you'd have sales minus total costs. Assuming that number's positive, you have a profit. Um, and you could do some more cool things like a degree of operating leverage. But anyways, I have a basic example here, a very very crude example here, because I left a lot off the table. Suppose we have some sort of factory lease. I did really really sloppy numbers here. We're annualizing some numbers here. So we got a 19,000 square foot place. Supposing you are able to get your hands on this factory, then secure it, and the lease is like $5 per square foot. Well, annualize, that's your lease expense. Uh, Equipment, we got, you coughed up 50K for it. You would think, it's got roughly 7 years of useful life, and you think maybe you could sell it for $10,000 at the end of it. Uh, using really, like, I am misusing what's called makers. There's actually a depreciation table there, and I used an oversimplified straight line. Straight line depreciation in this case, what I did, and feel free to yell at me if I did something wrong. But you have your cost of the equipment, the initial cost, less salvage value as your numerator, and then you divide it by useful years of useful life. And that that's your, roughly speaking, my case, misuse of depreciation expense. And because it's a factory lease, we're not assuming any sort of improvements. Very, very simple. Again, left a lot on the table. Like there's probably a whole bunch of other things like R&D expense, insurance, uh, friggin' you name it. Like SG&A, like things need to get marketed. And again, crudely did some unit economics here. Unit economics of electricity per unit, whatever the heck we're making. Could be really, really cheap shoes, could be really, really cheap, I don't know, some sort of widget, a widget spinner, because fidget spinners, I don't know if those are still around, but 3 cents of electricity per unit, 25 cents for direct labor. We're not talking like, the lawyer that you'd have in some other office. We're not talking, you as the founder CEO. We're just talking the laborers, uh, raw materials, whatever input goods. Maybe this would also include packaging, or you'd have packaging as a separate line item, whatever. And then we got a sales price. Assuming you've been able to lock in a deal with some retailer, some distributor, you get $10 for every unit you ship out. So what I did was, for this really, really crude example, did some really, really crude, like what happens if we make 1,000 units, 10,000 units, 20,000 units, and 0 units for a given year, and simple, really, really simple math. You know, take your sales per unit divided by or multiplied by goods produced or goods sold. Ideally, it would be goods sold, not the goods produced, because if you overproduce and you don't lock in those sales, that could be a problem. Rather, that will be a problem. And again, naturally, it grows. Imagine that this part here, this area doesn't exist. Uh, so I also tallied up variable costs. Now, variable costs, I may have gotten ahead of myself, and I apologize. A little rusty here, but the heck are variable costs? Well, a factory lease. You signed up for this. This is a fixed cost. This, some might say, is a sunk cost. If you're academically inclined and people have multiple choice questions, we don't count this as a variable cost. Equipment, the money that you put in, that is definitely a sunk cost. We don't count that for variable. Depreciation, believe it or not, that in this case, and I'll give you a real world example here. We're not counting it. We're just counting the direct costs for whatever widget we're producing. So 48 cents per unit, and naturally, your variable costs go with each unit. So pretty simple as, or rather, your variable. Yeah, there we go. Variable costs go for each unit. You know, so variable costs naturally go up as you produce more. Um, that being said, if a person were entrepreneurially inclined or investor inclined, there are scales, there are limits. Like say you're a car maker, you like a car manufacturer can only run at such a capacity. Like at some point, no duh, a single car factory cannot produce uh huge amount of like a billion cars off of a single car factory. Like if it had this square footage, like I think it's safe to say we'd be skeptical, and some sort of cost would have to go up. Um, so variable costs. Again, just be aware because again, like maybe for labor, if you increase these numbers, some people need to get paid overtime. Like that may be a thing. Uh, Fixed costs are, I did some things up here. Wait, did I sum up? Yeah, I just summed up factory lease and depreciation expense for a year. Oversimplified because there'd be so many other costs, and this is flat. Even if you produce 0 units, still a fixed cost. Granted, the depreciation is not a cash expense, but still an expense nonetheless. So you can do cool things like attach fixed cost per unit. So we got our total fixed costs divided by units sold. And naturally, your fixed costs will move with your activity of your production, or, well, rather, hopefully just production, but realistically, sales. So, assuming you can lock in those sales, your fixed costs naturally go down with your units. And this is where I threw down profit question mark because you take your sales less total like costs, so variable and fixed. And in this oversimplified example, obviously we did not produce enough units or sell enough units to generate any sort of profit. This case, still no. This case, holy crap. So roughly eyeballing it, you could be like, all right, our break evens somewhere around 10,500 ish units. But there is a better way, thanks to contribution margin, because we get to do sales less variable costs, and we could also do contribution margin ratio. Again, sales less variable costs as a numerator divided by total sales again, and then we can do our break even analysis where we would take our total fixed costs because we know what our total fixed cost is. We know whatever, or like hopefully we should know. And if we do, grow the business, then obviously this changes. But like we'll be able to see, what our fixed expenses are, our insurance, our leases, what have you, assuming they don't change in the period. We got our numerator locked in, and assuming that the market's still viable, we got our sales and our variable costs or a contribution margin as our denominator. And we can clearly see, hey, our break even is here. And, just because I'm a little bit of a paranoid person, I did 10,579 units and bumped it up also one more. Naturally, we can see how it flows. So, yeah, this is this is not too complicated. If a person were to be also have, or if a person were to have an economics background, or even just any general math background, this should come relatively naturally. But not everybody has this, and not everybody knows. And I wanted to take a look at some of the people here. Hello, Milk Shakespeare. Hello, Dex. Thank you for stopping by, swinging in. Hope this is good value add. Again, it's high contribution margin, low contribution margin. So much of it revolves around what your cost structure is. Is it very variable cost? Is it very high with variable costs? Could it be very high um, with labor costs, like say a Walmart, or could it be very high fixed costs, like in theory, a Microsoft, a software company? That changes the nature of the contribution margin, and unit economics do play a role, and it just is. Like I get that the natural appeal these days is higher or better unit economics, and it is important, don't get me wrong. Like at the end of the day, profit's profit, and that is why the appeal of modern day tech companies, especially on the software side, is very very powerful. But uh it's just a trade-off though, because if we were to model things out, supposing you were a capital light company where you didn't need to do a factory lease, where the office lease is far lower than this, and you don't need as many laborers or employees, and you certainly don't need as much equipment costs, and therefore your depreciation cost is low. Then you would think, oh well, that's just great. Our unit economics are freaking amazing, and they should be. But like I said, left a lot off. Uh, R&D is one of those things that's a little murky as far as how you apply it. And at the end of the day, I would hope that many of us have the common sense to at some point care about the bottom line, as well as cash flows. Um, so what the heck is all this? This is again, to repeat myself. This is non-gap. This is and some of us might be inclined to be like, non-gap, this is BS. Why are we talking about this? Harumph, we care about the integrity of accounting. And the punching bag has been EBITDA, or adjusted EBITDA. But I want to give a real world example. A company called Smart Sand Inc., ticker symbol SND. And I pulled up two examples, both their 10K and their 10Q, their most recent ones, as we can see here. And what the heck do they do? Ultimately, they uh, you know they get acquire sand and distribute sand, by and large, for hydraulic fracking. Basically, it. But we can do something here and go down. Sorry, I just wanted to show the very top, and we can see the management is nice enough to give contribution margin. Uh, this is non-GAAP, because, like I highlighted earlier, gross profit does not equal contribution margin, and we can see this play out right here. Revenue, so we got our total sales, less cost of goods sold. If we know our income statement, that means gross profit. But things like depreciation, or in this case also depletion, because any sort of natural resource mining activities, more or less, there's a depletion component. Um, that actually gets added back in to our gross profit. And the company says, hey, this is our gross margin. And they're even nice enough to say, hey, this is our unit contribution margin per ton of sand. And they also, are nice enough to give their activity on an annualized basis of, this is how much we sold. So, based off of the very crude example that I just gave, you could take a look and see the unit economics of this company. Uh, you know, I'm not here to say that this company's a buy or a sell or anything like that. It's just more of a, hey, like even Smart Sand's investor presentation, down right there. Uh, please work. I want to be smooth. Uh, damn, not very smooth. Um, yeah, contribution margin right there. Uh, it's a good idea to, when you take a look at an investor pres, to double check it with the relevant filings, to make sure that there's no discrepancies. Believe it or not, that has happened. I'm not going to name names, but I have seen it with my own eyes. Uh, so, thankfully, in this case, though, they actually do a good job of it, because this is the 10Q, the most recent one, and this was off of their investor presentation, their most recent one. And I know that this is really, really ugly. I apologize. Let me see if I can bigify. Um, just got to make sure that your periodicity lines up here. And with our 10Q, I'm double checking that I'm sharing properly. Yep, I am. Cool. Um, yeah, yeah, that this added up with that right there. Um, and 2024. Oh, funny. Look at that. See, you always want to make sure that it lines up. And 2024 is right there. Um, oh, and this was 2023. Yeah, and 2023 um, was right there for revenue. So again, uh, it's there. This is an example of how it would look like, and you can model things out that way. Just because there would fundamentally be a point where you're doing too much or you're doing too little, and you're not either generating a profit or you're not even breaking even. And again, this ignores some very, very important things such as SG&A, any sort of overhead costs, because fixed costs come with a lot and are very important. And I didn't even talk about interest expense either. And we as any sort of either investor or operator should care about that. So yes, that is the long and short of it. I thought about degree of operating leverage. Uh, uh, it's fine. Like maybe I'll revisit it and add on to it. But you know, contribution margin divided by the simple definition of profit, or quantity times contribution margin divided by that. Um, and you can see that contribution margin here is one of those things where economies of scale can show up. So suppose you're in an industry where you just want to get big for the sake of being big and you don't have economies of scale. All you've done is just increase your fixed costs. And if your contribution margin hasn't changed at all, then you've crushed everything. Like so much is ruined. Your break even is all out of whack because you increase this number without changing this. Then you got to really crank up those sales numbers somehow. Your operating leverage, if you really crank this up, you've shrunken any sort of output number. uh, and it's that being said, though, if you do have economies of scale, if you're, say, a Walmart compared to a mom and pop shop, you could probably do things like negotiate better, leasing costs than a mom and pop that's a small little retailer. And if all things considered, relatively speaking, your fixed costs are, if they translate to your unit costs or fixed cost per unit, it shrinks. Then you can obviously see, hey, Walmart, no duh, has economies of scale and is able to push its weight around, so to speak. So that right there is an example of uh, of things where contribution margin doesn't look as cool as, say, a tech company, modern day tech company. And you know it's from a relative basis, things are defensible. Uh, so that is one way that you could explain defensibility of a company. So yes, that being said, um, oh, Andrew's. Oh no, Andrew's here. That being said, I wanted to thank you all for patiently waiting for any sort of content. Andrew and I will coordinate. We still have to do joint venture accounting. That one's an interesting topic in and of itself. I will. I wanted to record a video of and upload a video like tomorrow of me doing contingent liabilities, just conceptually, because I know, like, so many companies get sued these days, and some of us may not be familiar with how that looks in financial statements, and it does show up. Uh, where it shows up though is it depends. So that's a little bit of a teaser for future content. Still working on what other topics like such as interviews. I've interacted with some people behind the scenes that are hopeful for modeling, and that I want to say that like part of negative two accountants one gap, where I'm solo, I help give people like some basic tools that they can input into a model, such as in this case contribution margin. You're if you're a car manufacturer, like yes, there's a finance arm. Most modern day car companies have one, but if you're analyzing it just from that aspect of the business, it would be nice to know, hey, we can roughly estimate costs. If there's an expansion in the works, roughly estimate more costs and what break even prices would be, so on and so forth. Because stories are great. Like a story is really cool. It'd be really cool, way back when, and a Chevrolet builds a new factory for a new car line. Oh boy. But at the end of the day, unit economics don't necessarily lie, and this is a way to do it. I mean, if you give me some rough estimates, I'm almost certainly going to get it wrong. But this is a way to help temper things. Like I said, if in the case of our young entrepreneur, with really crude, left a lot of stuff off of the line items here. Example, I just roughly eyeballed and spat some numbers out without even contribution margin. I'm like, oh, break even somewhere around here, and thankfully, contribution margin gave us an exact unit breakdown of assuming the costs don't change too much, and no disasters happen. Uh, yeah. Um, so yeah, there is the value add, hopefully. And a little bit on what's to come, what to look forward to. I thank you all for sticking around. I have a thing to attend with my sister. She's politely dragging me out to some concert. I don't even know who the artist is, but uh, that being said, please do consider liking, commenting, and subscribing. And hopefully, we continue to give you value. If I messed anything up, please do say so down in the comments below. Do appreciate any feedback. And, if there's any topics that you would like to see, please do share that as well. And, Andrew and I will try to do what we can to, keep providing value to very common questions that we see, and hopefully it is proper value. That being said, hope you all have a good one, and I will see you all around on the next time.